All right, so Glenn asked a question here, or Todd, excuse me, Todd. Todd writes in, he goes, "Hey, Josh, thanks for all you do. I learned so much through your work. Question, looking at your S&P 500 spreadsheet from 1960 to 2018, I'm trying to better understand the risk, reward, and earnings against price. I believe I have an understanding how you calculate earnings and dividend yield against stock price, but I do not understand how a huge drop in the S&P 500 can happen while earnings are still high. Looking at 2007 and 2008, the S&P 500 dropped 38%, yet the earnings yield was 5.48%, the dividend yield was 3.15, totaling a total return of 8.63 on someone's return on investment, even though the stock value went down 38.49. Can you help me better understand this? Yeah, absolutely. So this is actually pretty easy. So if you look at, there's three things that determine short-term gains. All right, and the number one, let's start with the premise. Three things that determine short-term gains: dividends. That's the dividend yield you're getting. So if the S&P 500 pays 2%, you're going to get 2%. That would go into your short-term gain. Earnings growth year over year. If the S&P 500 expected earnings growth is 5.5%, that's what you should expect for your earnings growth year over year plus a dividend. So you'd expect to get a 7.5% yield, a return on your assets. But the other one on the short term is a whole lot more volatile, and that's just a price appreciation or price fall. And that is basically behavior of investors. That's all there is to it. So investors say, look, we expect the earnings to drop like a brick in water, which is essentially what they predicted in 2008 and happened. And so the earnings fell off a cliff for many corporations. And because of that, a lot of investors reacted accordingly. So they felt they sold their shares and whatnot. But even if earnings don't drop like a brick, the threat of an earnings decline scares people. So the price can drop even if earnings stay high. And that always happens. That's the thing. That's the anomaly. So there's three things that you need to factor in short term, and that is the people's perception of buying and selling stocks. And if they perceive the stock market as more legs, they're willing to pay higher prices for $1 of earnings. I hope that makes sense. So if you look at 1982, when Business Week published, was it 79 of Business Week? I can't remember, but maybe it was 81. But Business Week published on their front page the death of equities. And I think it might have been 1981. I can't remember. But anyway, the death of equities. The PE ratio of the S&P 500 is like 8, all right, because people did not expect capitalism to survive. So they were not willing to, and on top of that, you had huge inflation, you had stagflation, a high unemployment, the whole thing. So people were not willing, regardless of what the earnings yield was on the earnings growth year over year of stocks, they were not willing to pay more for it. They just weren't. They said, we're not going to pay more for $1 of earnings because we don't believe in the longevity of the market, essentially. And so because of that, you could get a huge bargain on stocks in 1982. 8 PE ratio, like a 6% dividend yield. I mean, it's nuts, man. And if you have an earnings growth because the Reagan economy kicked in, I mean, that's just hell's bells. So what happened was you have earnings growth growing at a huge clip. We'll just say 8%. You have dividend yields that start off pretty high, but slowly dropped as the prices of the stocks went up, more so than the dividend growth. So you still had an initial dividend yield of 6, but it slowly dropped as the prices went up relative to dividend growth. But you still had this huge earnings yield. But then you had more and more people willing to pay more money for $1 of earnings. They're willing to pay 9 for $1 earnings. They're willing to pay 10 for $1 earnings. Fast forward today, they're willing to pay 21 and 22 for $1 of earnings. So the price appreciation is always the anomaly, always the variable. We just don't know what people are going to be willing to pay. If people think a recession is coming, or they think that Trump's going to win, or what's the other lady, Bernie, whatever, is going to win, they might be less inclined to pay for a high price for $1 of earnings because they think that the earnings will drop, and that's always the wild card. We just don't know. But if you look historically, over time, the wild card always gets exhausted. So basically what that means, it always plays itself out. So sometimes the wild card is you're trading at PE ratios of 40, like we had in 1998 and 1999. Other times you have PE ratios of value stocks right now and financial stocks, 10 and 12. I mean, it basically comes out as a wash in the long run. Probably a little bit more geared towards an increasing PE ratio with more people optimistic about the markets more than pessimistic. But that can change. I mean, literally, that can change if we get high inflation, low earnings and whatnot, and stagflation. That would change immediately, simply because people say, "Well, I do not trust the markets. I don't trust the inflation. It's going to eat away my money, so I'm going to go ahead and pay off." I don't know what people do in inflation. I've never had to deal with inflation my whole working life. That's a fact. So, I mean, what people do in inflation, they buy things today because they don't want to save, because if they save, the value of that dollar will decline. So when it's an inflationary economy and people see this inflation, they said, I got $1 here now. I want to buy something for $1. I'm going to buy for $1. I'm going to consume it today because that thing that costs $1 today will cost $1.25 tomorrow. And I won't have $1.25. I'll have to come up with more money to which I can buy a thing for today. So in an inflationary economy, people consume. That's a big thing. They consume more, even though they don't want to consume, but they have to, they think, because they're losing money just by going to there. You know how they say on the internet, make money while you sleep, and inflation is lose money while you're asleep. On the other hand, deflation is the exact opposite. People don't want to consume because they say prices are going to continue to go down. So if I want that iPhone, I'm going to wait till next year or next tomorrow because it'll be priced, as opposed to $500 today, it'll be priced at $400 tomorrow. So I'm not going to buy it today. I'll wait till tomorrow. And so that's the issue with deflations. People don't consume, they don't spend, and they don't invest. They actually just keep their money hoarded. And so that's the dichotomy of inflation versus deflation. At the end of the day, though, the earnings growth year over year plus the dividends is all that you really need to know on any 5-10 year stretch. And also when you're talking projections, I mean, because when you're projecting returns, you can't fathom what people are willing to pay for $1 of earnings. You can't make a predict. I mean, you can make a prediction on it, but your prediction is I mean, it's just heads I win, tails I lose. I mean, it's literally a 50-50. You could be right, you could be wrong. So I don't use any predictions on earnings. What people are willing to pay for $1 of earnings, because there's no basis on behavior. You're predicting people's behavior, and there's nothing to base that on. If anything, you should base on people being pessimistic more than optimistic, just because people gear towards being pessimists rather than optimistic. So you can always base it on people are not going to be willing to pay higher and higher prices for $1 of earnings because people are inherently pessimists. But I don't think you can use that in your projections. So if you think that people willingness to pay an increasing price for $1 of earnings or a decreasing price for $1 of earnings, it comes out in a wash, which I do, then for projections, you say the only way we can make an assumption about future returns is earnings growth year over year and dividend yield. That's it. And now earnings growth year over year can change without question. We know that for a fact, but I don't think a 5 to 5.5% year over year earnings growth is anything extraordinary. I don't think a dividend yield could change too, but I mean, show me the evidence that's going to, and I just don't see it. So in that case, you're projecting it based on, I think, pretty solid evidence that earnings growth year over year, I'm pretty comfortable projecting. And I'm not just pulling that out of my butt. I'm using Vanguard stuff, Schiller stuff, Siegel stuff. I mean, so this is what people project. And we'll have some new reports coming out at the end of this year with JP Morgan, Vanguard. They'll have their own projections. Seems like I have something else I want to say on pessimistic versus optimistic. I can't remember anymore. But that's how it works. You got earnings growth year over year, dividend yield, and then you got appreciation or depreciation, depending on what people feel about their own behavior. That's it. And I just, so you go back to 2000, but that's what I was going to say. If you look at 1921, all right, you give it a perfect example, just like in 2008, the markets fell off a cliff, and it coincided with earnings falling off a cliff. So the same thing happened in 2008. The earnings fell off a cliff, coincided with the markets falling off a cliff. I mean, that's just the nature of the beast. Will it be a perfect one for one? No, nothing's ever perfect. I mean, this isn't engineering or physics, because behavior still plays a role in this. So for the long term, earnings growth year over year, dividend yield, and you're fine. All right, we'll see you.